Hi guys, we've got Mr. Suresh Soni with us,
Hi.
the CEO for Baroda PNP Paribas Asset Management Company. And we were having some chats, so I thought it's best to, get it on for our viewers and for our clients. So let us start on the
Sure.
lines of what we were discussing. First, what is your view about the global economy? Let's start from the global side.
Sure. So I think what we have been through is a period of extreme volatility. So the events which happen in 100 years happened with us just in the last 3, 4 years. So what you have seen in the last 3, 4 years is the most volatile news flow, if I could call, starting from COVID, followed by Russia, Ukraine, followed by the events that you had with Hamas and Israel conflict. So what you're going through currently is a period of heightened uncertainty in the world where you're seeing the hot wars as well as cold wars between different economies. So be it US and China and concerns around China, Taiwan, as well as hot wars which are happening around. And which is why over the last few years, if you have seen the assets like gold have done reasonably okay, or you have had relatively high volatility in the markets because of these reasons. Also, the other side, if I were to really cover from the economic perspective, what you have seen is extreme volatility in the policies as well. So, when you went through COVID, suddenly the economies collapsed. And in order to help economies recover, what did the central banks around the world do? They brought down the interest rates sharply. So, what you had in 2021 was a sharp reduction in interest rates and negative interest rates in almost 62% of the outstanding bonds in the world. What followed after that was huge amount of monetary stimulus, but as well as huge amount of fiscal stimulus, which we call helicopter money in US as well as in a lot of advanced economy. And with that, then you had a huge round of inflation. So it is for the first time in my career in the last, let's say, 30 years or thereabout, I saw US inflation or UK inflation being significantly higher than India. And you had double digit inflation in UK, you had close to 9% in US, and that led to the huge amount of monetary policy tightening. So first you had rate cuts, then you had rate hikes. And we are now going back to probably a rate cut season again. So political uncertainty, number of headlines, as well as sharp volatility in the monetary policies.
How do you foresee this? The point that you put up was about Japan and China story unfolding.
I think what we are witnessing right now is, if you really look at the world, about 85% of the world market cap is explained by three economies, which is US, Eurozone, and Japan. These three account for about 85% of global market cap. India would probably be about 1.8, 1.9% of the world market cap. What you're seeing interestingly is that all three of these markets, whether it is the US S&P 500, Euro Stock 50, which is essentially an indicator of European market, as well as Japanese Nikkei, touching new highs. All in the
30
period
years.
of last 6 years, in the last 6 months. And yes, like you said, in Japan, Nikkei, you're seeing it touching 30-year high because it did nothing for 30 years and now it's kind of reached a new high. And it's interesting that at a time when there is a global uncertainty, the equity markets globally are rejoicing. Now, coming to China, I think China is a unique market, which is essentially right now at its 52-week, close to 52-week low, or the lowest low, probably even in the last 3 years. And there are heightened concerns there around the local construction, as well as the government's policies around, which are seen by a lot of people as negative to the businesses. And that is where India, in a certain way, is benefiting from some part of the money outflowing from money as well as FDI, looking for places outside of China.
Coming back to India, on the India story, 5, 6, 7 trillion in the next 5 years. Where do you see the India story unfolding?
So I think it's very interesting that at a time when world has been a volatile place and there's so much uncertainty, India continues to chug along very well. In fact, I would say that this is one of the finest moments for India in the last 30, 40 years that I have seen. And why do I say that? I say that because whenever we look at economy, there are two parts to it. One is, of course, growth. And second, durability or stability of that growth. India does exceedingly well in both the dimension. You, of course, possibly know that we are the fastest growing large economy in the world. Now, second, third year in a row, 2024 is also likely to be that. But alongside that, we have done extremely well on the stability dimension of the economy as well, which means that our fiscal deficit is remarkably under control. Our inflation is under control. Our foreign exchange situation has done quite well. Our foreign exchange reserves are now at the highest level in the last 2 years. So throughout this period, India has done very well on growth as well as on stability dimension, which interestingly makes it one of the best performing market or best placed market in the current juncture.
Isn't India expensive?
Well, you want quality, you have to pay the price. So let's get to the numbers. At the end of the day, when we are analyzing investment, I think it's good to be number oriented. India has never been at a discount to MSCI. So MSCI Emerging Market Index, if you really look at it, India has traded between 25% to 75% premium to the MSCI Emerging Market Index all through the last 10 years. Today, this premium will be somewhere around 50 to 55%. So we are somewhere around, let's say, middle to slightly higher part of that range, but not at the highest premium to MSCI Emerging Market Index. And given the scale, given the durability, as well as given the growth that you see in India, I don't think that should be a cause of worry. Second thing is, in fact, if you really look at it, foreigners have not really been huge buyers in India for the last few years. In fact, over the last 5 years, FI holdings in India has come down from around 20% of their market cap to 18% of the market cap. I do think with the economic prospects that we see for India, as well as political stability that markets are perceiving, probably we would have greater FI flows in the coming period.
Nice. Let's get back to the market caps.
Sure.
Large, small, and mid. We've seen a pretty good rally in almost all the sections. A lot of people actually missed out on a lot of fund managements missed out on the PSU rally. But what is your view on the large, mid, and small first to start with? And then we'll probably have a little bit touch base on the sectors.
Sure. So I think the way we, of course, classify from mutual fund parlance as well as from SEBI and AMFI perspective, top 100 stock in India are called large cap. Next 150 are called mid caps. And everything other than these 250 stocks are called small cap. The small cap per se is not a small section. It's probably a collection of about 2,000 or thereabout in investable stocks. And actual listed stock will probably be about 4,000 to 5,000. So it's a very large universe. And one of the problems with large universe tends to be that if you take averages of a very large number, you don't get sensible data because you would have extremes within that. So on a generic basis, I would say that mid and small cap are currently at a premium to large cap. That's not something that we see usually for a long period of time. So normally what you see is that valuations tend to converge. They may be at a slight discount at some point of time and a slight premium, but today we find premium on small cap to be a little higher than what we have witnessed historically. So in general, I would say that from a valuation perspective, the average is higher than what we have seen. But within that average, I think one of the things for large numbers is that averages conceal as much as they reveal. So within that averages, there would be stocks which are yet attractive, but there would also be stocks which are expensive. So on a generic basis, I would say on an average, large cap is cheaper than mid and small. But there would be specific pockets which could be attractive within the other two segments.
Very nice. Another point, PSU as a sector, we have seen a huge upside in PSU. Some of it was captured by Baroda Asset Management Company. A lot of fund managers actually missed out on the PSU story.
I think PSUs, to be fair, have over a period of time actually done a few things very well. PSUs have structurally been high dividend paying companies. It's because the owner, which is largely the government, wanted them to give out regular flows, right? Second thing is, I think all of them are also subject to a relatively strict audit by CAG, which gives you a certain amount of confidence on their accounts. And a number of them work in strategic areas and do enjoy near monopoly in some of those sectors. So some of these factors have actually worked well for some of them over a period of time. Added to that, the fact that as they are more listed, there is also a little more focus on profitability, and the government has actually been pushing for it. So some of these companies have actually, over a period of time, delivered pretty good performance and have also been, let's say, more reliable in terms of their accounting and reporting, as well as become more, let's say, predictable, given the fact that they enjoy a certain amount of dominance or, let's say, a certain amount of ability to execute and scale. So some of those factors have come into play. Market, indeed, I must admit, did ignore them for a long period of time. And the valuations came down to a level where some of the PSUs were trading at dividend yields which are better than the bond yields.
No.
And that has led to some amount of, let's say, reorientation in the market where PSUs have done well. I do think if I look at it today, and again, I think we have been able to participate in some of these stocks over a period of time. So this has done fairly well for us. But if I look at the pockets today, there are pockets where things have gotten a little bit too optimistic. So there are areas where things are optimistic, but then there are also other areas where some of them are still at reasonable valuations. So I won't say the entire PSU pack is reasonable. There are some pockets where there are some optimism about certain stories. They have gotten a little expensive. One other thing that we have to understand in the markets is that, oftentimes what really happens is that while the performance of the companies goes in a straight line, and over a period of, let's say, next 5 years, 7 years, the markets have a tendency to discount next 7 years in 1 year. So you would find some of those pockets in specific stories. And sometimes the market can get optimistic about, let's say, a certain theme which is running, maybe defense, maybe railways, and some of these, where valuations can get stretched. But other than that, I think you do find that there are well-performing companies available yet at a reasonable valuation in some other areas.
Now that you touch base upon the sectors,
Yes.
specific, which are the sectors that you feel, like defense you just spoke about, that is probably optimistic and has already shown some upside? Which are the sectors you feel still are undervalued and can be looked at from the investment point of view?
Sure. So I won't say that today's market is a market where you get a dollar at 20 cents. It doesn't give.
It doesn't happen that way.
So let's be reasonable that broadly the market is not cheap. And the pockets where we find there is opportunity to create value are probably cheaper by 20-30% as opposed to, let's say, being cheaper by 80-90%, which happens sometimes, of course, when markets are in an extreme zone. So the sectors which we find are attractive today are broadly in three buckets. One, I think from a valuation standpoint, certain pockets like consumer hasn't done too well over a period of time. And that's one area where India as an economy continues to evolve, continues to grow. So that's one area where we do think that there are good pockets available, both in the discretionary and non-discretionary space. And that's a theme that will run for a long period of time in the country. And there the stocks have probably not performed for a period of last few years. There are also some prominent private sector banks where sometimes what happens is markets have a tendency to over project a short-term negative
For a longer.
for a longer period, and therefore stocks get ignored for a long period of time. And there would be pockets there as well. In addition to that, I think we tend to be bullish on capex as a theme, because we believe that while government has been leading the capex charge in the last few years, now we are reaching a point where private sector is stepping in as well.
Nice.
So the capex as a theme will continue to do well. And that in turn benefits attended sectors as like cement and a few other sectors as well. So that is a theme that will kind of do well.
That brings me to another question that you just touched base upon. BFSI as a segment post COVID, and I surprisingly it is not in India only. Globally also, I can see some resemblance that BFSI has not done so well post COVID. Like good companies like or banks have not posted very, very good market cap growth for that matter. Do you see value there?
So in BFSI, essentially what happened immediately after COVID were, as the economy went through a sharp drop, you did worry about the credit quality. And let's remember that banks are a leveraged play on the economy. Most banks would have a capital adequacy ratios of around 12-15%, between 10 to 15%, which means that they have a leverage of around 7 times or so. And when a bad loan cycle happens, this hits this particular segment really hard. So when the COVID hit you, you got worried about defaults, delinquencies, both in consumer as well as in industrials. And that's why the sector had to really fall once. Following that, however, the sector has actually delivered reasonably well. And, the performance has held up quite well.
Yeah.
So from there on, the recovery has been good. Overall, I think the sector performance post the COVID drop has been reasonably okay. We still find certain pockets which are good here, but we are a little more bullish than as compared to the core lenders right now. We are a little more bullish on the segments which are, let's say, into the wealth management, broking, and some of the other areas.
Okay.
Core lending, essentially the way it functions is for all the banks, you have pre-provisioning profits, and then you have the provisions.
Yeah.
What is happening now is with the rates tightening, the NIM is getting a little compressed for the lender.
Plus provision increases.
Plus provisions, in fact, on the last couple of years, you have benefited by provisioning right back because of the NPA recovery. We are not sure whether it can continue at the same pace. So compared to lender, we prefer the capital market plays in the BFSI segment.
What would be your suggestion for anybody who is already invested and somebody who wants to invest right now? Two different category of customers. So already invested, made some decent money. Would you want him to move from a large cap to a balance advantage, or from a small cap to a large cap? And whoever wants to right now start investments, what would be the advice?
Sure. So one thing that I've realized over a period of time is that not everybody is able to time it perfectly. I think oftentimes what happens is timing really requires you to sell at the right level and buy back also at the right level. More often than not, people will get one side of the story right. But you probably overstay that position and never able to get back in time. And I think for most investors who are not trying to super optimize, I would say staying invested is a good choice. You, of course, can, within that, you can calibrate a little bit by that. If you were overexposed to small caps or a certain segment which has done extremely well for you and has given you relatively very high returns, and you want to kind of move it to a large cap or something, or maybe if you are very overexposed to equity and want to go a little more into balance, those are some optimization that you can do, but please do not stay out of the market. One thing that I think all of us sitting in India have to realize is that investing would continue to make money. I think this is a market which over the last 25 years has delivered around 15 to 16% rupee return and 11 to 12% dollar returns. We are actually the best performing equity market in the world. And this is a market which delivers you twice the return on equity roughly as compared to the fixed income. So getting an allocation here in equity from a long term, absolutely sensible. If you are in that small minority who thinks that they can time the market perfectly well, then try and optimize it. But more often than not, for most people, staying invested would make sense. For somebody who's starting early part of the career, I do think you should consider making regular investing into equity market, start an SIP. I think I wish 30 years back when I started my PPF account, I started SIP.
SIP also.
That doesn't matter. Maybe I did it a little later, and that still worked for me.
Yeah.
So today you have a lot of choices to invest, and I think India is in a very strong place today. So make long-term commitment to investing.
Another thing was on the quarter three results. We saw Nifty results broadly. If you look at the results, one view is that it showcases a sound economy. Some pockets, estimates were high, results were pretty good. Estimates were low, or expectations were low, the results were pretty decent. I think one view was on the IT. IT as a sector. I think the expectations were lower and the results were not so bad. What do you foresee in the IT side?
Sure. So one on the whole, on the results, I think our results have been fairly good on aggregate. I think we have seen our earnings grow at about 19-20% in the last quarter. However, a large part of that is coming from profit expansion. The top line growth has been about 5% thereabout. And from a story perspective, I think results present sound profitability. However, I would have loved to see higher sales growth. So for this economic growth, I think our sales growth has to be a little higher. So that was slight disappointment for me on the turnover growth, but profitability-wise, corporate India in a great shape. Coming to IT specifically, I think there has been a bit of a slowdown over the last, let's say, 18 months or thereabout in the company's performance, as well as you've seen some amount of slowing in the growth. But please remember that this is one sector where India has a huge competitive advantage. We started 25-30 years back as a back office to the world, but today we are at the cutting edge of the technology. Most of the tools are getting developed in India now. India is at the forefront of digital revolution. So very frankly, I think this is one sector where we have a cost advantage as well as we are more innovative and we are at the forefront of it. Every time a new tool comes, there is a fear that it will lead to job losses. But frankly, what really happens is you get efficiency gains far more. There's some amount of reskilling required, but on the whole, the economy benefits. So I do think IT is one area where India has a huge competitive advantage. We are actually bullish on this sector from a medium to long-term perspective. And while we were underweight earlier, we are neutralizing that. And we will probably, for all you know, we would go towards overweight over a period of next 6 to 12 months.
Nice. One of the favorite questions.
Sure.
Pre and post election. I think some bit of it was kind of market started discounting probably with the state elections and all. What's your view on the election and its impact?
I'm yet learning to learn about the markets. Election is beyond my capability zone, so I don't forecast elections. But I think what we do is we try and prepare ourselves for various outcomes. And of course, currently with the state election out of the window, there seems to be a consensus building towards the continuation of the same regime. And then you, of course, try and see as to what are the signals that you're getting from this regime. And I think it was heartening to see that even in an election year, they chose the path of fiscal consolidation, at least in the interim budget that they presented. Not the interim, but the budget that they presented. So overall, I think we seem to be in a good place. We should see continuation of the kind of industry-friendly policies as well as pro-investment policies that we have seen. So if you really look at it, what has changed in India over the last 10 years is essentially our tax collections have gone up by about 2% of GDP. So tax to GDP ratio has gone up by 2%, and that entire 2% is actually gone into capex. So our capex used to be about 1.5% of GDP, which is now 3.5% of the GDP. And over that period, the size of the economy has also grown. So if you really look at pure capex from in the country over the last 10 years, it's gone 10 times. And that is leading to the infrastructure projects that you see all around us. Of course, you would complain about the roads because of the bridges being built and all of those things happening. But that also means that there's a lot better connectivity that is happening.
That is happening.
So India is finally making investment in infra. I do think that would continue to happen. Because some of these things are, once you started, irrespective of the government, nobody's going to change it.
Yes.
Whether it is the digital that adoption or any of these things. So therefore, I think we are in a very good spot. And I do think the coming decade for India should be a lot more exciting than what the past decade was.
Also, as you mentioned about the budget, there was allocation into defense and renewables quite a lot. Renewables energy side,
Yes.
the valuation also seems to be decent. Any play out there from the fund or from the asset management side that you're looking at?
There are few plays out there that a lot of solar power or some of these energies are in the more in unlisted space. In the listed space, you have a few players, but apart from renewable, in fact, we are actually running into a situation where we are also running short of the traditional power supply. So one of the interesting part that has happened is that in all this narrative about renewable, people forget that we also need sustainable thermal energy. Because, for example, solar power is available to you at the time when you don't need it. So our peak deficit in the country happens in mornings and evenings. Those times solar power is not available to you. We don't have the ability to store it properly. And therefore the government is finally realizing that we need to go back to thermal power. So interestingly, nearly after about 6-7 years, we are seeing a lot more thermal projects coming up as well. We are also seeing hydro projects coming, and of course solar continues to be there. So we will not only see the growth of renewable, but we will see growth of all the energy sources. And that's where I think you have some interesting plays in the overall power sector, I would say, rather than just targeting renewable alone.
Interesting. So one of your best performing funds has been the Balance Advantage Fund. What's your view on the Balance Advantage Fund?
So I think as a category, first of all, Balance Advantage funds serve a very interesting purpose for people. Because they allocate money between equity and fixed income on a dynamic basis. Interestingly, what I've observed over a period of time is that these funds tend to be lesser volatile compared to equity funds, but do manage to capture a decent part of market performance. So if I look at our own fund, for example, over the last 5 years, our average equity allocation in our Balance Advantage fund, Baroda BNP Paribas Balance Advantage, would have been about 55%. But in terms of performance, it would have done almost in line with the Nifty performance. So you got about 55% volatility, but you almost captured the entire
upside.
And how we have been able to do is because we actively allocate money between equity and fixed income depending upon the market valuations and our view. So when post-COVID, when the markets fell, our equity allocations in this fund went to as high as about 87% of the portfolio. And sometime in 21, when the markets became a little expensive, our equity allocation was down to about 35%. So while you got the upside on about 80% plus of the market, your downside was limited to only 35%. So as a result, what you got was a lot smoother ride. And at the same time, you got the participation in market. So Balance Advantage, I think, as a product does that quite well. I think what we tend to do is we have an in-house model which takes into account the market factors and then guides us on the equity allocation. And we have created this model after analyzing almost about 3 decades of data. It worked in the test environment for about 3 years before we went live, and now it is live for 5 years, and you see the results have been extremely satisfactory.
To the latest one, which is the Innovation Fund. What are we trying to do with the Innovation Fund? And first, congratulations on raising more than 900. I think you touched about 1,000. So what are we trying to do with the innovation fund?
So I think very simply put, the idea is very simple for innovation. I think, see, you might have come across this saying that only paranoid survive. And I would also add to it, only innovative thrive.
Oh, nice.
So essentially what happens around us is over a period of time, unless companies keep pace with the market changes, whether it is consumer trends, whether it is technological changes, you are not able to deliver. If you stay steady, you just can't grow. You will perish over a period of time. So the focus of this fund, and I don't want to confuse it with just technology, but innovation can happen in the way you deliver something to people. So from people going to restaurants to food coming to their home is an innovation. Smart use of technology or shift in EV from petrol is innovation. So it's beyond just IT. So it is basically companies which are innovative in their field. They get an outsized return. And this fund essentially aims to capitalize on that. So we have a universe of about 400 plus companies that we track. If you look at it from innovation filter, we find about 200 to 25 companies fitting that criteria, which are innovative and obviously therefore fast growing. So this fund would make a selection out of those 225 odd companies and create a portfolio. We are already fairly advanced in that because even before we launched the fund, we worked on the theme for a period of time, identifying the stock, researching what we think is the potential universe. So the fund is live, and while we collected what we collected in the NFO stage, I do welcome other investors to look at this fund. I think this is an interesting theme. And India actually has really earned its stripe now in innovation.
Innovations, yes. So that's really nice. And 3 pointers that you want to give to our investors or our private bankers. The relationship, actually.
No, again, I think I'm a perpetual student of the market, but a few things that I would tell you. One, investing is one field in which higher activity does not make better results. I.e., I think sometimes it's worth curbing the desire
to
overcommit. There are times when, as a fund manager, I walked into the investment desk, and when I went back, I said, why the hell did I come today? I mean, it was better if I did not do what I did today. So higher activity is not necessarily leading to better outcome. I think it's a sensible activity. So please make fewer calls rather than over trading, but make it more structural. So therefore, there is a certain method or conviction behind it, as well as there is a certain, let's say, discipline around it. So that's one, I would say. Second, I would say is that more often than not, I think most of our clients are under-allocated into risky assets or equity. It's a good starting point to manage by elimination, meaning setting aside what is the part of money that you need over the next 6 months to 2-3 years. And then look at that balance and therefore allocate it freely, as opposed to having to worry about, am I overextended, am I underextended, am I underinvested, kind of a thing. And the third one I would say is that today we are not in that situation, but when you're faced with volatile markets, rather than trying to be smart for tomorrow, try to think about what will get you ahead in 6 months. So try to close your eyes and say that, I don't know what's going to happen tomorrow. If I buy this, it might fall another 10%. But will I be ahead in 6 months' time when dust is settled down? If ever you did that around COVID time or any other time, I think it would have given you a lot more peace than trying to predict tomorrow. Forget about tomorrow. We won't get it right.
No, that's pretty Pretty nice. Thank you so much.
Delight talking to you.
It's a pleasure talking to you. And likewise, congratulations again on the fund and looking forward to have a meaningful partnership ahead.
Certainly. Thank you so
Thank you
very
so
much.